Everyone thinks the housing market only crashed in California, but the truth about what's happening in cities like Austin, Nashville, and Miami right now is absolutely wild. We found 10 American cities where your equity could be quietly disappearing, and nobody in the industry is telling you this. Let me ask you something. What if the house you bought, the one you stretched every dollar for, the one you told your kids would be their inheritance, is actually worth less today than when you signed the papers? Not in theory, not in some doomsday scenario. Right now, in 2026, in cities that just 3 years ago were on every hottest real estate market list in the country. Here is the uncomfortable truth that the real estate industry does not want you sitting with. We are watching a slow motion collapse happening across America, and it is not just in California. It is in your backyard. It is in your cousin's neighborhood in Texas. It is in that condo your coworker bragged about buying in Florida during the pandemic. And the worst part? The professionals who are supposed to protect you, the agents, the lenders, the analysts on CNBC, are still smiling and telling you the market is normalizing. That is not normalization. That is financial anesthesia. Today we are taking a hard, data-backed look at 10 specific American cities where the housing market is not just slowing down, it is structurally breaking. We are talking about markets where inventory is piling up like uncollected trash, where price cuts are becoming the rule instead of the exception, where the buyers have simply vanished, and where the equity that millions of families built during the pandemic boom is quietly evaporating. If you own property in any of these cities, this is not a video to scroll past. And if you are thinking about buying in any of these markets, you need to finish this before you write a single check. Let's go. Number 10. Austin, Texas. We are starting deep in the heart of Texas, in a city that became the poster child for the pandemic real estate gold rush. Austin was the dream. Tech companies were relocating. Tesla moved its headquarters there. Elon Musk planted his flag. People were buying homes sight unseen, waiving inspections and throwing $100,000 over asking price just to get into the game. The energy was electric. In 2026, the electricity has been shut off. What happened in Austin is a textbook case of a market that got ahead of itself. The influx of California money drove prices to levels that the local economy simply cannot support on its own. According to Zillow data, Austin has seen one of the steepest year-over-year price declines of any major metro in the United States. We are talking about homes that peaked in 2022, now selling for 20 to 25% below those highs. That is not a dip. That is a crater. The deeper problem is the inventory explosion. When Austin was hot, builders went absolutely wild. They permitted and built as fast as humanly possible. Now, the supply has caught up to, and in many areas, lapped the demand. Redfin data shows active listings in the Austin metro have surged by more than 60% compared to just 2 years ago. Sellers are stacking up. And buyers? They are negotiating like it is 2012 again. Tech layoffs have also punched Austin directly in the face. The very workforce that was supposed to support these prices has been downsized, relocated, or is simply working from somewhere cheaper. The dream has not died in Austin, but it is absolutely on life support. Number 9. Phoenix, Arizona. Phoenix has been through this before. If you were around in 2008, you remember what happened when the desert bubble popped. Well, pull up a chair because the sequel is in production. Phoenix was the single hottest real estate market in the entire country during the pandemic. People flooded in from California, from the Pacific Northwest, from everywhere. They brought remote work paychecks and big city appetites for space. They bought everything. Then the interest rates went up. Then the remote work mandates came back. Then the math stopped working. According to the National Association of Realtors, Phoenix is currently sitting on one of the largest inventories of unsold homes it has seen in years. Days on market have roughly tripled compared to the pandemic peak. Sellers who bought in 2021 and are trying to move up or move on are discovering a brutal reality. Their profits have shrunk dramatically, and in some zip codes, they barely exist at all. The investor class made things significantly worse here. Institutional buyers and individual speculators gobbled up properties throughout the pandemic with the intention of flipping or renting. Now, with rents softening and holding costs rising, many of those investors are quietly trying to exit. When investors sell in bulk, it floods the market and pushes prices down fast. Phoenix is living through that right now in real time. Number 8. Boise, Idaho. You might be surprised to see Boise on this list. It is not a massive market, but the percentage swing happening here is genuinely alarming, and it is a warning for every mid-sized city that got swept up in the pandemic migration frenzy. Boise had the distinction of being one of the fastest appreciating housing markets in American history during 2020 and 2021. People fled larger cities and discovered this clean, outdoorsy, affordable gem in the Pacific Northwest. The word got out. Then the money got in. Prices in some Boise neighborhoods nearly doubled in under 3 years. Here is the problem. The local economy in Boise was never designed to support California-level housing prices. The average wages here are significantly below coastal standards. Once the remote workers stopped coming, either because companies called them back to the office or because Idaho prices were no longer the bargain they once were, demand evaporated almost overnight. Redfin reports that price reductions are happening on a stunning percentage of active listings in Boise. The correction is violent by historical standards because the run-up was so irrational and so fast. Homeowners who bought at the peak are discovering there is an invisible floor in Boise, a price ceiling set by local incomes, and it sits well below what they paid. This is a city where the gap between aspiration and economic reality is absolutely brutal. Number 7. Las Vegas, Nevada. What happens in Vegas stays in Vegas, including, apparently, your equity. Las Vegas is a market built on entertainment, hospitality, and optimism. But in 2026, the economic foundation beneath the glittering strip is shaking. The short-term rental market, which boomed during the pandemic as Vegas became a hub for bachelor parties and weekend getaways, is now suffocating under its own weight. Too many investors bought too many properties, and the rental income projections they used to justify those purchases were based on peak occupancy numbers that simply have not materialized consistently. AirDNA data tracking the short-term rental performance in Clark County paints a grim picture. Occupancy rates have fallen, and average daily rates have compressed sharply as competition has exploded. Investors who locked in at 7% or 8% mortgage rates and projected $250 nights are now pricing at $120 just to get bookings. Meanwhile, the broader market is feeling it. According to CoreLogic, foreclosure activity in the Las Vegas metro has ticked upward meaningfully compared to prior years. The cocktail of over-leveraged investors, softening rents, and a broader slowdown in discretionary spending is toxic for this market. Vegas may be the city of second chances, but the real estate market here is not feeling particularly lucky right now. Number 6. Nashville, Tennessee. Nashville was supposed to be the city that had it all figured out. No income tax, a booming music and tourism economy, a relatively affordable cost of living that was attracting corporations and young professionals from all over the country. It was on every best city to move to list for 5 consecutive years. And then prices got Nashville arrogant. The median home price in Nashville jumped so dramatically that it now rivals cities with significantly higher average wages. According to the California Association of Realtors, and yes, analysts are comparing Nashville's affordability crisis to California now, the price-to-income ratio in Nashville has reached levels that have historically preceded significant corrections. The supply side has also caught up with a vengeance. Builders who could not construct homes fast enough in 2021 are now delivering those projects into a market where demand has softened considerably. New construction inventory in the Nashville suburbs is accumulating. Builders are offering concessions, rate buydowns, closing cost credits, free upgrades to move product. That is a direct threat to every existing homeowner trying to sell, because you literally cannot compete with a brand new house being offered at a discount. Nashville's economic identity is also more fragile than its booster class admits. It is heavily dependent on tourism, hospitality, and a transplant economy. When the broader economy tightens, Nashville's tailwind disappears fast. Number 5. Tampa, Florida. Florida has a new problem that is reshaping its entire real estate landscape, the insurance apocalypse, and no city is feeling it more acutely than Tampa. After a series of devastating hurricane seasons, insurance companies have been pulling out of Florida at a rate that is genuinely terrifying for homeowners. Citizens Property Insurance, the state-backed insurer of last resort, has been overwhelmed. Premiums for homeowners in the Tampa Bay area have increased by anywhere from 50% to over 300%, depending on the property and location. Here is why that is catastrophic for home values. When a buyer finances a property, their mortgage payment is made up of principal, interest, taxes, and insurance, what the industry calls PITI. If the insurance component of that equation doubles or triples, the total monthly cost becomes unaffordable for the same price point, which means to sell the same house to a buyer with the same income, you have to drop the price significantly. Redfin data shows that days on market in Tampa have extended sharply and price cuts are escalating. The luxury waterfront market, which was the pride of Tampa's real estate boom, is particularly exposed. Properties that sit closest to water are the most expensive to insure, or in some cases, becoming completely uninsurable from private carriers. If your million-dollar waterfront home requires a $40,000 annual insurance policy, the pool of qualified buyers shrinks to almost nothing. Tampa is beautiful, but the financial infrastructure supporting its property values is cracking under pressure. Number 4. Denver, Colorado. Denver was bulletproof. That was the narrative for years. The outdoor lifestyle, the cannabis economy, the growing tech presence, the young professional population. Denver was seemingly immune to the cycles that punished other cities. Turns out the bullet just took a little longer to arrive. Denver's housing market is now confronting the reality that a decade of near uninterrupted price appreciation created a valuation bubble that the local economy cannot sustain. The tech sector slowdown has hit Denver harder than most people realize. Companies that set up remote offices here during the pandemic are now consolidating, and the flow of high-income transplants has slowed to a trickle compared to its peak. According to Zillow, inventory in the Denver metro has risen sharply, and price reductions are now common where they were once virtually non-existent. The condo market downtown is particularly stressed. Urban density that once commanded a premium is now a liability as remote workers decide they would rather have space in the suburbs, if they stay in Colorado at all. The other issue facing Denver is property tax. Colorado recently saw significant property tax reassessments following the appreciation boom, and many homeowners were blindsided by bills that jumped thousands of dollars annually. When your carrying costs go up while your value goes down, it has a very particular effect on your motivation to sell rather than hold. Number 3. Charlotte, North Carolina. Charlotte flew under the radar for years. It was the financial services city with a skyline that was growing fast, a population diversifying rapidly, and housing prices that were still reasonable by coastal standards. Banks were headquartered here, young professionals were moving here. It was the kind of city that made you feel smart for discovering it before everyone else did. Everyone else discovered it. And now it has the pricing problem that everyone brings with them. In 2026, Charlotte is grappling with an affordability breakdown that mirrors what happened in Austin. Local wages are not keeping pace with the mortgage payments required to buy median-priced homes. According to the Mortgage Bankers Association, loan application volume in the Charlotte metro has declined significantly, which is the most honest signal the market gives you. When people stop trying to borrow, demand is genuinely disappearing. The overbuilding in Charlotte's suburban ring is also becoming a serious problem. Drive 20 minutes outside of the city center, and you will find streets of new construction that feel quieter than they should. Builders are cutting prices and offering incentives that are putting enormous pressure on resale values. The correction in Charlotte is still in its early innings, but the structural issues are real, and the trajectory is not encouraging for anyone holding property purchased at 2022 or 2023 prices. Number 2. Atlanta, Georgia. Atlanta has long been America's next great city, the black entrepreneurial capital, the Hollywood of the South, a logistics hub, a tech corridor. The energy in Atlanta is undeniable. But the real estate market has developed a very dangerous gap between narrative and numbers. During the pandemic and post-pandemic period, Atlanta attracted an enormous wave of domestic migration and investor activity. Institutional investors, the corporate landlords, bought single-family homes in Atlanta's suburbs at a scale that was genuinely unprecedented. Entire neighborhoods in places like Clayton County and South Fulton were absorbed by corporate buyers. This artificially inflated prices and suppressed inventory, which made the market look healthier than it was. Now, several of those institutional investors are quietly offloading properties. According to CoreLogic research tracking institutional sales activity, the sell-off is accelerating. When large portfolios hit the market simultaneously, the impact on pricing is severe. Ordinary homeowners who bought at the peak are suddenly competing against institutional sellers who have more flexibility on price because they are managing portfolio returns, not individual financial survival. Atlanta's rental market is also under stress. With so many single-family rentals concentrated in certain corridors, vacancy rates have climbed and rents have softened. That math is negative for anyone who bought as a rental property investor in 2021 or 2022 at peak prices and peak interest rates. This is a city with enormous long-term potential, but the near-term correction is going to be painful. Number 1. Miami, Florida. Miami. The city that sold itself as the new capital of everything: finance, crypto, Latin American wealth, luxury living. The city where the pandemic turned a regional real estate market into a global one overnight. Russian oligarchs, Brazilian billionaires, New York hedge fund managers, everyone was buying, and the prices reflected it. But in 2026, the tide is going out, and we are all discovering who was swimming without a suit. The condo market in Miami is entering a chapter that should terrify anyone holding vertical real estate here. Florida's new condominium safety laws, passed after the Surfside collapse, are requiring buildings to complete structural inspections and fund reserves properly. The financial implications are enormous. Buildings that were already operating on thin margins are now levying special assessments against owners, sometimes tens of thousands, sometimes hundreds of thousands of dollars per unit, to fund required repairs and reserves. This has created a catastrophic situation where owners are being asked to pay hundreds of thousands in assessments on top of mortgages, maintenance fees, and that catastrophic insurance premium we already talked about. The response from many is, "I cannot do this," and they are listing. Inventory in Miami's condo market has exploded to levels not seen in years. According to Redfin, condo listings in Miami are sitting on the market for extended periods, and price cuts are becoming universal. Buyers are aware of the assessment risk and are demanding steep discounts or walking away entirely. The international buyer, who was Miami's safety net through multiple previous corrections, is less active due to a stronger dollar, geopolitical uncertainty, and concerns about the long-term sustainability of Florida's insurance environment. The single-family market in Miami is also beginning to crack under the weight of insurance costs and the reality that remote work migration into Florida has plateaued. Miami still has immense appeal, but the financial structure holding up its sky-high valuations is under significant, sustained stress. For Miami to recover, it needs lower interest rates, a stable insurance market, and a new wave of wealthy buyers. In 2026, none of those three things are certain. So there it is, 10 American cities, 10 different sets of circumstances, 10 warning signs that point to the same uncomfortable conclusion. The housing market across America is not in a normal correction. It is in a repricing of reality, and the gap between where prices are and where they can sustainably be is still closing. Now, I want to be clear about something. This is not a prediction that every city on this list turns into a ghost town. America's real estate market is not going to zero. People will always need homes. Life will always move. Marriages, divorces, new jobs, new babies. The transactions will continue. But if you are making a decision right now, whether to buy, sell, hold, or invest, you deserve to make it with clear eyes and honest data, not the optimistic spin of someone who earns a commission when you sign, not the fear-driven catastrophizing of someone who profits from panic. Just the numbers, the trends, and the structural forces that do not care about your timeline or your feelings. The cities on this list share one thing in common. The story that pushed their prices to the top has changed. The remote work revolution, the migration patterns, the investor gold rush, the short-term rental boom, those stories are over or dramatically scaled back. And when the story that supported the price disappears, the price eventually follows. If you are sitting in one of these markets right now, take a hard look at your situation. Get an honest appraisal. Run the numbers on what you actually owe versus what the market will actually bear today. Have the uncomfortable conversation with yourself before the market has it for you. And if you are watching from the sidelines with dry powder in your pocket, take a breath. The bottom is a process, not an event. Patience in a falling market is not weakness. It is the most powerful tool you have. Thanks for watching. If this helped you see things a little more clearly, hit the like button, subscribe for more honest market analysis, and share this with someone who has been told nothing but good news about their real estate investment. They deserve the truth too. Stay sharp, stay liquid, and I will see you in the next one.